Today we're going to talk about the impact of rising interest rates on commercial real estate. And I'm sure you've all heard that rates have been rising, the Feds have been pushing rates up, and you're worried, is this going to adversely affect me? Is it going to affect my salary, my ability to make money, and even the value of my assets? We're going to explore that today to figure out, is this good or bad? When it comes to interest rates, let's talk about the big picture. The Federal Reserve, often called the Fed, is the central bank of the United States. One of its main responsibilities is setting monetary policy, which includes setting interest rates, such as the federal funds rate, which is the rate at which banks can borrow money from the Fed. The Fed uses these interest rates as a tool to influence the economy, lowering them to stimulate growth and raising them to slow down inflation. And that's exactly what's happening right now, because they're concerned about inflation. They think things are getting too hot. So they have been increasing rates to slow down the economy. With increased rates, people borrow less often. They don't expand their businesses quickly. They don't buy as much real estate. They're trying to slow things down. Of course, the commensurate challenge is that if you slow things down too much, you go into a big recession. And that is why, just to give you a preview, I don't think rates are going to go up much more. But let's explore this a bit. Interest rates, of course, have a major influence on the value of a commercial property. In fact, the value of a commercial property is a multiple of its rental income. In fact, you could say it's the rental income divided by the cap rate. And that is strongly influenced by whatever the prevailing market rates are for money that you have to borrow to buy a property. So commercial buildings are priced based upon their rental income and the market cap rate. Current cap rates are around 6%. And what that means is that if you buy a building, it would take about 16 2/3 years of that rental income to pay back the capital outlay of your building. Clearly, the higher interest rates are, the harder it is to borrow money, and the lower they are, the easier it is to borrow money. So they tend to go in unison. And when the economy is good, people are willing to spend more to buy a certain amount of rental income, so cap rates come down. And when the economy is bad, they don't want to spend so much to buy that same rental income, so cap rates go up. One interesting thing to note is that while interest rates tend to be the same in any one country at any one time, cap rates can vary. For instance, if you've got a city in the middle of nowhere, cap rates might be quite high. They might be 20%. Investors want a 20% return to invest in the city where there's an unknown growth factor or whatever. Whereas when it comes to, say, Wall Street in New York, people are so confident that they'll always have a tenant there that they're willing to accept a very low return. Cap rates might be 2%, which means investors are willing to spend 50 times the rental income to buy that rental income because it's in a good location. So cap rates vary by geography, and also cap rates, as we've seen, vary over time, and they tend to follow interest rates very closely. Here's a graph showing you that there's very close alignment between the two, and that's why from a commercial real estate investor's point of view, it's so important to know where interest rates are going, because that's going to have a big effect on cap rates. We started by saying that interest rates have been rising, and I know many people are really worried about that. They're also worried about a recession, and I've seen a lot of talk about a recession, more so than I think is justified. But here's the interesting thing. From what I've been reading, the Feds might increase interest rates one more time this year, but they too are worried about a recession. Remember, they increase interest rates when they want to slow the economy down. But if it's true that we're headed anywhere near a recession, that means a slowdown of the economy, and the government's going to want to stimulate the economy, and the way they stimulate the economy is by dropping interest rates. So right now, I'm not overly worried that interest rates are going to keep on going up and properties are going to be priced out of the market. Not at all. I perceive that by the end of this year, we'll start to see a falling off in Fed interest rates. A truly successful investor, however, can invest during times of economic hardship or economic good times, whether interest rates are rising or coming down, whether cap rates are high or low. A good investor will know how to beat the average. And I have a tool to help you beat the average. It is called 101 Ways to Massively Increase the Value of Your Real Estate Without Spending Much Money. And you can get your own copy of this book free of charge by clicking the link below. This book will show you what you can do to a property to massively increase its value, obviously, whether it's a good economy, whether interest rates are on the rise, whether it's a bad economy, or whether they're coming down. Click the link below to secure your copy today. I hope you feel a little less anxious about rising interest rates and changing cap rates. I think it's fair to say that a successful investor knows how to do well in any part of the economic cycle. As always, I want to wish you successful investing, and I look forward to seeing you in the next video.